Dear shareholders, as chairman of the newly appointed board under the Yes Bank Reconstruction Scheme 2020, I take this opportunity to introduce to you a redefined Yes Bank. At the outset, on behalf of the board, I thank the Government of India, Ministry of Finance, Reserve Bank of India, State Bank of India, HDFC Limited, ICICI Bank, Axis Bank, Kotak Mahindra Bank, IDFC First Bank, Federal Bank, and Bandhan Bank for their extraordinary and timely support through the Yes Bank Reconstruction Scheme 2020, which was made effective March 13, 2020. It is the first such bank-led reconstruction plan in India's banking history. Further, the plan has been exceptionally well conceptualized and flawlessly executed by RBI and the investing banks. The bank greatly appreciates the support extended. With the backing of India's largest financial institutions, Yes Bank has been truly re-energized. Your bank is steering its way forward by learning from past challenges, expeditiously addressing key issues, and becoming stronger while continuing to focus on supporting our customers and all stakeholders. The bank's new board had just embarked implementing the reconstruction scheme during difficult market conditions when the COVID-19 situation erupted and swept across the world, forcing governments to impose nationwide lockdowns. This created an additional complexity to an existing difficult situation which the bank faced on account of legacy issues pre-implementation of the reconstruction scheme. Given the unprecedented situation, the bank's management team, under the leadership of the new MD and CEO Prashant Kumar, immediately repositioned itself and dealt with all internal and market-related challenges admirably to restore customer and depositor confidence. In addition to the special liquidity facility of Rs 50,000 crores extended by Reserve Bank of India, the bank has since received strong customer liquidity inflows. I am very pleased to report that the bank has fully repaid this facility of Rs 50,000 crores to the Reserve Bank of India on September 8, 2020, well before its due date. Meanwhile, Yes Bank has made significant progress. More importantly, the bank successfully raised equity funding of Rs 15,000 crores through follow-on public offering in July. That is within 4 months of the restructuring scheme amidst very challenging market conditions. This truly demonstrates the strong confidence of institutional and retail investors in the bank's restructuring plan, action taken, future roadmap, and its professional management under the new leadership. Pursuant to the encouraging developments in the bank and equity capital raise of Rs 15,000 crores, I am very pleased to report that on August 3, 2020, Moody's Investor Services upgraded the bank's rating to B3 with outlook as stable. More recently, CRISIL has revised the rating from A2 to A2+ for certificate of deposits, and India Ratings has revised the rating from IND BB-RWE to IND BB/stable for infrastructure bonds and IND B+/RWE to IND BB-stable for Basel III Tier 2 bonds issued by the bank. This is a testimony of the positive changes implemented in the bank within a short time frame. The Moody's rating improvement rationale, as reported, was due to a successful FPO which bolstered the bank's solvency and improved financial strength. This will support depositor confidence. Following this capital increase, the bank's pro forma common tier CET1 ratio has doubled to 13.4% from 6.6% at the end of June 2020, bringing its capitalization largely in line with its private sector peers. The significantly improved solvency ratio strengthens the bank's resilience to potential asset quality risks resulting from the impact of the economic slowdown and COVID-19 related disruptions on India's economy. India experienced moderate growth, demand contraction, low pace of investment, and weaker credit offtake. The adverse impact of global political uncertainty arising from US and China trade war and Brexit-related developments impacted external trade. In midst of a watchful turn of events on a global scale, COVID-19 was declared as a global health emergency by WHO as the fiscal year came to an end. The imposition of a stringent nationwide lockdown to contain the spread of COVID-19 led to an unprecedented economic slowdown, prompting series of conventional as well as unconventional policy responses from Reserve Bank of India and the government. The banking sector, as also emphasized by the RBI governor, needs to create buffers to ensure effective credit flow, to develop resilience in the financial system, and cushion against the economic impact of the COVID-19 situation. Guided by RBI, the banking system has responded admirably by offering a loan moratorium to customers amongst other responses. Given the uncertainty and full economic impact of COVID-19 on key sectors, it is difficult to fully ascertain the implication of the moratorium in the short to medium term and will need close monitoring by banks. Your bank is also closely monitoring the developments and its impact on the credit portfolio. Looking ahead, financial year 2021 will be a year of transition as we battle health and economic impact of COVID-19 and simultaneously reinvent ourselves as a nation. India's fundamentals continue to remain strong with its structural strengths of vast consumption base, young demographics, and with an aspiring middle class. The potential is limitless. In these difficult times, I must commend the coordinated efforts of the central and state governments, municipal authorities, and regulatory bodies to insulate all of us from the larger health issues, livelihood, economic, and financial fallout of COVID-19. I applaud the immense contribution of essential service providers, including healthcare professionals, delivery, police personnel, amongst many others, selfless workers who tirelessly safeguarded the nation during this period of an extreme health and consequent economic crisis. Our compliments and gratitude to them. Embarking on a journey of transformation, the bank has made considerable progress towards achieving targets set by the new board. It reflects the resilience, resolve, and perseverance of the management team to bounce back despite enormous challenges and a complex economic environment. While successfully navigating intensive transformation or change is always daunting, I have immense faith in our reinvigorated team to rebuild the bank to its rightful position amongst the leading domestic and global banking peers. The support received from all stakeholders, particularly the unwavering confidence of our customers, has been most gratifying. It has enhanced the determination of the new board and the management to build an institution which has highest standards of governance, strong risk processes, financially strong, technologically powered to deliver best value to our customers. The bank is working on three pillars of sustainable growth: driving operational excellence through digitization, strong governance and risk frameworks, and sharing success with all our stakeholders. These combined lay the foundation of our transformation journey. The board of directors of the bank recognize that we must continue to strengthen and augment our oversight along with governance and risk management practices. Acknowledging that strong corporate governance is key to success of an institution, the board has identified culture of compliance as a key asset that we need to nurture and cherish. A culture of transparency, integrity, trust, accountability, and collaboration. The importance of good governance cannot be understated, which was also emphasized by RBI in its recent discussion paper on improving the quality of governance and empowering the board of directors to set the culture and values of the institution, identify and manage conflicts of interest, manage risks, while also improving the supervisory oversight of our senior management. In order to ensure effective risk management practices which benefit all stakeholders, in recent months, the board has ensured efficient risk frameworks are put in place so that risks are identified, evaluated, and addressed appropriately. Much of the work undertaken is not only to meet regulatory requirements, but also to make the bank stronger, agile, and efficient. The bank's board continues to work closely with the management to identify and deal with all impending issues vigorously and appropriately. We are closely monitoring the stress on our credit portfolio on account of legacy issues, current macroeconomic and COVID-19 situation. Operating a revamped Yes Bank, we are mindful of our fiduciary responsibilities to our customers, shareholders, employees, and the regulator. We believe our coordinated efforts, together with shareholder support, will help us to honor them. This is also the time for the bank to increase its focus on environmental, social, and governance issues. As we move forward and embrace the new normal, we aspire to be a bank which is trusted for integrity, practices higher standards of governance and risk management, is technologically contemporary, and continuously motivated to deliver value to all its stakeholders. The board and I feel a deep sense of pride to be part of an institution which continues to show remarkable resolve and confidence towards delivering these positive outcomes. The achievements and the change would not have been possible Without the strong support of the Government of India, Reserve Bank of India, other regulators, investors, valued customers, my board colleagues, and more importantly, over 21,000 highly enthusiastic and committed Yes Bank employees. Thank you all.